China is turning its stock market from a casino into a technology engine. If you've been watching over the past few years, you've probably noticed something pretty strange. Despite tariffs, export controls, growing decoupling from the West, China keeps producing new AI labs, robotics companies, new EV makers, new semiconductor firms. Why is this happening? It comes down to China's 10-year project to transform their stock market from a platform for speculation and quick money making to a platform where the whole of China can 100% focus on making insane new tech. I first came to China about 13 years ago. Back then, the economy was still riding the real estate boom. As for the stock market, most ordinary people didn't really treat it as somewhere to build long-term wealth. It was referred to as chou gu piao, stir-frying stocks or flipping stocks. You buy, sell, and you hopefully make a quick profit on your subway trip back home after work. Around 2015, when the bubble hit, retail investors made up about 80% of daily trading volume. Insider trading scandals and information leaks were common. Corporate governance varied enormously. IPOs were tightly controlled by regulators as well. Once the market crashed in 2015, authorities suspended IPOs, they halted trading in thousands of stocks, and they stepped in to stabilize prices. The thing back then, though, was that the stock market wasn't really where China financed its economy. It was mainly state-owned banks, local governments, and private financing that was calling the shots, until Beijing realized something in the late 2010s, about a decade ago. The old model, real estate, construction, and infrastructure, was reaching its limits. The new model would have to be scientific research, startups, venture capital, IPOs, and ultimately advanced manufacturing. But that only works if you have a stock market, because equity markets are much better at allocating money smartly than state-owned banks are. So in 2019, China launches the STAR market, designed specifically for AI, semiconductors, biotech, and advanced manufacturing. Maybe what's most important is that they shifted IPOs towards a disclosure-based system, which leaves much less power in the hands of regulators to stop an IPO and leaves much more over to the market. China strengthened up delisting rules to be able to clear out old zombie companies, and then they encouraged more long-term investors like pension funds, insurers, mutual funds, and ETFs, instead of just guys sitting on the subway trying to make a quick buck after work. Now today we saw 4 new reforms. One, ETF trading was refined because Beijing now wants Chinese households to invest broadly in sectors like AI, semiconductors, robotics, and advanced manufacturing instead of just buying up more real estate. 2, to let large institutions move billions of yuan around more easily without moving prices. After hours trading was expanded across the A-share market. 3, block trading rules were also improved. And 4, to make buying and selling stocks for growing companies easier, China next introduced market makers in Shenzhen. Now on their own, these policy shifts are pretty insignificant, but together they are part of a much bigger ambition, and that is to build a financial pipeline that runs smoothly from university labs to angel investors to venture capital, IPO, pension funds, institutional investors, and at the end of the day, into the next generation of Chinese technology mega companies.